Dividend investing is a straightforward and effective strategy for generating genuine passive income. By purchasing high-quality dividend stocks and holding on to them long-term, you allow your investments to grow over time. Meanwhile, you can focus on things that truly matter to you. In this video, we will explain how dividend stock works, pros and cons of owning dividend stocks, how to pick dividend stocks, and show you an example to make $93,000 with only $1,000. First, let's see the definition of dividend. This is the money that a company sets aside from the profit to reward shareholders. When you own shares of a company, it will reward you in the form of cash known as dividends. If a stock pays dividends, then it is a dividend stock because not all stocks are paying dividends. Usually, this payout is quarterly, but some stocks are paying monthly. There are companies like Costco that pay special dividends in some years. So this is a form of passive income. That's why we are seeing people that are living off dividends because they are owning enough shares. And the dividend payouts are able to cover living expenses. There are 4 concepts that we need to know as dividend investors. Announcement date. This is the company management announces the dividend payment. The dividend must be approved before they can announce and investors get paid. The next one is ex-dividend date. Investors have to buy the stock before a specific date to get the dividend payout. For example, if June 1st is the ex-dividend date, then investors have to buy the stock before June 1st to get paid a dividend. After that, investors will get paid in the next quarter. Record date. This is the date when the company determines which shareholders are eligible for the dividend payout. And finally, payment date. The date the company pays investors dividends. Now let's see what are the pros and cons of owning a dividend stock portfolio. Starting with the pros first, number 1 is passive income. All you need to do is buy and hold the dividend stocks. You will get paid dividends at least 4 times a year if they pay you quarterly, like Home Depot. Some dividend stocks are paying investors every month, so you get paid 12 times a year, like Gladstone Investment. When you start investing in dividend stocks, the return may seem very small, but as time goes, the more shares you have, the bigger the dividend payout you will receive. Constantly contributing a certain amount of your income every month for a long period of time, you will be able to live off dividends eventually. Number 2. Protect your assets against inflation. The average inflation is about 3% per year. If the dividend yield is over 3% and the dividend is also growing every year, then you can easily beat the inflation. For example, Realty Income has a current dividend yield of 5.8%. This number has beaten the inflation already. Now the dividend growth rate is 3.83% per year on average in the past 10 years. So you know the second year your return would be 6.02% on the capital you originally invested in year 1. In year 2, your return would be 6.25% of what you invest in the beginning. Essentially, you are getting higher pay every year with high-quality dividend stock. Number 3, compounding. At the beginning of the investment phase, you want to set up dividend reinvestment. Every time you receive a small amount of dividend, it will purchase more shares for you. More shares will pay a higher dividend next time. By utilizing this method, your investment would grow much faster than you expect. Now, let's talk about cons. First is limited returns. Most companies that are able to pay out consistent dividends are large cap companies, where the market capitalization is over $10 billion. These companies have been in the market for decades or even over 100 years. They went through multiple wars and recessions, so their products or services are needed. These stocks usually have limited growth. You will not see amazing growth like Apple or Nvidia in the recent years. Second, companies can cut dividends anytime. Because we own shares of a company, that does not mean they are obligated to pay us dividends. If a company is experiencing hardship, it will have to cut dividends to recoup funds for operating the business. Walgreens cut its dividend in 2024 despite having been paying and raising dividends for 47 consecutive years. For long-term investors looking for passive income, investing in dividend stocks is a good idea. If you are looking for high growth, then dividend stocks should be part of your investment that provides stability for you. Now the question is, how do we know which stock is good for our portfolio? Well, let's see some metrics. The first one is dividend yield. This is the annual dividend by the share price. If a company pays $3 as annual dividend and the current share price is $100, then the dividend is $3 divided by $100 equal to 3%. What if the dividend is $5? Then the dividend yield is 5%. You may think 5% dividend is a better choice. In fact, a higher dividend could give you a better return, but is not necessarily a good thing. It could be the company does not reinvest any profit back to the business or the stock price dropped a lot. The second metric is dividend growth rate. We know the inflation is about 3% per year, so it would be great for a company to have a dividend growth rate also at 3% or higher. We don't want the company to pay us the same dividend every year. Otherwise, it is not a good investment. For example, Johnson & Johnson had a dividend growth rate of 6.02% per year in the past 10 years. 6.02% is higher than 3%, so this is a metric we would like to see as long-term investors. The third metric is payout ratio. Let's say a company earned $100 million last year and distributed $40 million as dividends to investors. Then the payout ratio is 40 million divided by 100 million equals to 0.4 or 40%. This is a reasonable payout ratio. Usually, payout ratios between 30% and 50% are considered healthy. Between 50% and 70% are acceptable. Anything above 70% is considered high, so we will have to consider other metrics as well. The fourth metric to evaluate is to see if the company has a solid track record. We would want to hold on to companies that have been paying good dividends and also increasing dividends year over year. A good example of this is Hormel Foods. The company has been raising dividends for 57 consecutive years. It shows the commitment of Hormel Foods to reward shareholders. Even though dividend is not guaranteed, a longer history of paying dividends increases the likelihood that the company will continue to do so. That would give us peace of mind. Based on the 4 criteria above and the initial investment of $1,000, we should diversify our investment into 4 stocks, and each stock should be in different sectors. These stocks are Texas Instruments, Lowe's, BlackRock, and AbbVie. There is not a strong correlation among each stock. Here are their dividend yields, dividend growth rates, and share price appreciations. Now let's take the average of each metric. The average dividend yield is 2.7%. The dividend growth rate is 13.6% per year, and the average share price appreciation is 12.69% per year. In 10 years, the investment would become $3,902 with an annual dividend yield of $125. In 20 years, this investment would be $18,530 and the annual dividend is $705. In 30 years, this investment would be $93,096 with an annual dividend of $4,215. This is 93 times in return. $1,000 is not a huge amount of money, but investing in the right stocks can grow your wealth really fast. Thanks for watching. Be sure to hit the like and subscribe button for more helpful tips like this. See you in the next video.